I'll be candid. What I didn't like about the capital gains discussion earlier this year was the way it was framed, the way it was toned. It was a kind of class warfare type language, which, well, as if we're entering an era where if we're going to be successful, we need some people, some companies, some Canadians to be successful, and that doesn't mean they're bad people, that they've done the wrong thing. In fact, they will have done what we want them to do if we have a clean tech entrepreneur, carbon capture, those people, and they get to scale. If a Canadian company is the world leader in small modular reactors, for example, which is necessary for so many solutions around the world, yeah, actually, we do want them to see some again. They're not bad people. They're good people. They're part of what we need to do. So then, how do we balance that? And how do we balance it through overall levels of taxation of income on the way up? And do we have some form of is it around capital gains? Do we have capital gains at the right level now?
And is there a way to distinguish at times between active and passive income? Because take housing as the classic example. But if you've got and I mentioned this example earlier, but if you've got dollars coming in to build, I want to incentivize that every chance I get. More dollars coming in to build, but I want to disincentivize, if anything, dollars coming in to compete with first-time home buyers in the residential resale space. That's not productive capital in the same way. And you could have a tax regime that treats
you can have a tax regime
differently,
and you can have and we do have some of this, which is you can have other elements of the regime which support the first-time home buyer, which tilts the playing field.